Welcome to Cherry Street Investor Education with Kavitha Baratakke, passive income coach and founder of Cherry Street Investments. Education that is designed for you to take control of your financial life. Join us to learn how you can create multiple passive income streams, diversify your portfolio, save on your taxes, and much more. Become a better investor and fast track your financial goals.
Welcome everyone. Thanks for joining in. This is farther, faster together, how to accelerate your investing with syndications. I'm Kavitha Baratakke, a founder of Cherry Street Investments. I do a lot of multifamily syndications in addition to syndications and other commercial assets like senior living and self-storage facilities. I'm looking at some new ways of investing my own capital and diversifying my own capital, which put me to kind of drew me to doing this presentation. A lot of times I focused on multifamily syndications and just talked about multifamily as an asset class, but I wanted to put together a more generic presentation, if you will, on syndications and what a syndication is, how they are structured, what that means to you from an investing perspective. So thanks for joining in today. I hope this is useful. And if you have any questions along the way, please feel free to type it in the Q&A box. I don't usually check the chat box, so it scrolls by with comments. If you have any comments, please drop that in the chat box. And if you have any questions, drop that in the Q&A box. Just to give you a brief idea of where I come from, I'll talk a little bit about myself, but for those of you who are new, and I do see a lot of new faces today, but let's quickly look at what I'll be covering today. I have a lot of things to cover. So I'm budgeting a little over an hour. I would say closer to an hour 15, and I'll leave about 15-20 minutes for questions. I hope you can take that time and come here and learn with me. So let's talk about why invest passively. What's the need to invest passively? Because when people think about real estate, they always think about buying a single family home. So what is this passive investing and what does it mean to you? What is a syndication? What is the structure of a syndication? Why even consider a syndication in your investing? The parties in a syndication, typical return structures for a syndication, the steps of a syndication, returns, the kind of returns in a syndication. So there's return structures and there's actual returns. So I'll kind of allude to a little bit to both. Of course, the returns are just the generic returns and everything depends on that particular asset that you're investing into. And also talk about types of syndications, types of investors, what are securities? And this is something you should understand when you go into syndications. And there are two types of what we call a Reg D structures. It's 506B versus 506C. We'll talk a little bit about that. What are the typical documents that you will see in a syndication and how syndications can help you diversify your assets. I'm also going to talk about stuff I couldn't even fit in here, cap rates. What do cap rates really mean to you? What is a forced appreciation? What are some of the typical ways in which we perform or conduct these syndications? So it's going to be a lot of information in a short amount of time. So I hope you guys are prepared for this. Before I jump into that information, just a little bit about me for a lot of folks who are new here. I'm Kavitha Baratakke. Like I mentioned, I'm the founder of Cherry Street Investments. I came from Bangalore, India in 1998, and I came here for grad school like a lot of Indians do. I was in tech, just like every Indian I know is either in tech or is a doctor or a dentist, maybe a few lawyers here or there. So I got into tech back in Bangalore because it was just the Silicon Valley of India growing up. I came here with to do my master's after my bachelor's in India, spent 20 years across Wipro. I spent 15 years in IBM and 5 years in a company called Atlassian, all tech companies. Along the way, in 2008, I was trading in the stock market, and you guys know how all that went. And truly, I didn't lose a lot of money as much as I lost a lot of money in my 401k. My 401k, like most people, was half, right? And I thought to myself, there's got to be a better way to invest than what I'm doing. And Yes, I'm diversified across small cap, large cap, and all these different ways that financial advisors say you need to be diversified, but I still lost half my 401k in the 2008 crash. Yes, it recovered, but when you look at the total returns, when it takes 6, 7 years to recover, it's not that much. You left a lot of money on the table in terms of growth. So anyway, long story short, I started trading options. I made some money. I decided I'm going to invest in real estate because at that time, the market was trashed, right? And I thought this is a good point for me to get into the market because houses are selling for $54 a square foot, which is below the build cost or replacement value for these homes. So I bought my first house in Austin at $98,000. And needless to say, obviously that's done really well. I spent a lot of time buying houses until I realized I can't handle one more tenant and deal with one more problem because it's just one of me and too many houses. And property management companies that I tried were really frustrating me. So overall, I decided single family was not the way for me to scale up. So I moved into apartment investing. And that led me to actually becoming a full-time apartment investor. I started doing more of multifamily investing and since I kind of financially freed myself, I was making enough passive income. I left tech and I moved into full-time real estate. So I still have about 2,200 doors, or what's called units, number of units, as a limited partner. And I'll talk about who a limited partner is, and 1,400 doors as general partner. And I'll talk about what that means to you guys when you actually get into a syndication. I'm a founder of Cherry Street Investments. My focus is education. I love educating people. I love seeing sort of the light bulb moment for people when they learn about these things. So I focus a lot on that. I conduct webinars every 2 weeks, sometimes every week as well. So feel free to please sign up and join me for future webinars. I help people invest passively in real estate, and I also focus on what's called infinite banking policies for investing, college planning, and retirement. So I'm also a realtor in Austin market, although I do much less of the realty than I do everything else. So just a little bit about my company. These are all the things I do. As mentioned, passive, active investments, which is the brokerage side, and life insurance, infinite banking policies. If you're interested in any of these, feel free to reach out to me. I'm happy to chat with you. As I mentioned, education is my primary focus. So with that, I do have a YouTube channel. If you go to my YouTube channel, Cherry Street Investor Education, you can find a lot of these recorded webinars. Every webinar, every piece of education, I do a lot of short videos as well, is out here. It's free. It's for your consumption. Please subscribe to the channel. So every time I upload something, you will get a notification that there is some new education online. So what is passive income? The way passive income is defined is money you earn in a way that requires little or no daily effort to maintain. Now, whenever you're working in a full-time job, whenever you're, let's say, even doing a business, you're putting in a lot of time to earn that money. So in that sense, the work you're doing is not passive anymore. So when your money can make money for you, we call it passive income. So with that, I want to say, is owning and operating rental homes a truly passive income activity? What I found out in my own experience was that it wasn't really a passive income activity, because I was spending a lot of time managing these tenants, managing property management companies, because things were breaking, maintenance issues, toilets, and now the snowstorm happened, pipes broke. So all of that didn't make it very passive for me. So I decided I had to do something better than what I was doing, which brings me to this sort of foundational diversification. I always talk to investors and ask them, where are they diversified, right? A lot of people are in the speculation, or what I call the stock market, which is actually the tier 4 of the diversification. So there are other tiers where, let's say tier 1 is your savings. How good do you have savings? Is your life protected? This is the lowest risk, highest control tier. And above that is like direct investing. If you're buying a single family home, if you're buying any kind of investment that you have direct control over, this is the tier you fall into. Now, indirect investing is what I'm going to really talk about today, is your tier 3 or syndications, where you don't directly control the investment, but you do get exposure to real estate through that investment, right? And then you have your tier 4. I find that a lot of investors have most of their 401ks in tier 4 and most of their non-401ks in tier 4 as well, which is when I encourage people to look at these other tiers and see that they are diversified across these other tiers as well, and not just in the highest tier, which is your tier 4. So, a couple of reasons why invest passively. So when you buy a single family home, you just buy a single family home, right? You have this one unit and you don't have any economies of scale when you're dealing with one unit. Let's say you buy 20 units across different parts of town or different cities, you still don't benefit from any economies of scale because your units are all over the city, presumably, right? Even if your units are all in one neighborhood, you still don't have the economies of scale that you can have when you own something like an apartment, which has 100 units, 200 units. The second reason to invest passively is that it's a truly passive income with no time or effort. So you put in the money, hopefully with a sponsor that you trust, and that's really important. And then you just sit back and you collect the checks. It's truly zero income, zero effort on your part. The first bit of thing I want to say is that there is effort upfront. You need to vet the deal. You need to vet the sponsor. You need to make sure that this is something you want to do and you're comfortable doing. And I've turned down many investors who say, I want to do it, but they're not willing to relinquish control. So if you're a control freak, this isn't for you. Syndication is not for you, because syndication involves some level of trust that someone else will manage that property for you. So you really have to be willing to relinquish control. The third thing is cash flow and equity growth. So like any real estate, a lot of people now want to buy in Austin, want to buy in all these hot markets. There are only so many single family homes to go around, right? There are only so many apartments to go around too, which is why now we're looking at building new apartments as well. Because housing is a precious commodity right now. People are just moving into Texas like, I don't want to say flies, but there are a lot of people moving into Texas. And it's just the housing just can't keep up with the demand and the job growth and the population growth that we're seeing in Texas right now. And it's true of a lot of other places besides Texas. I don't want to single out Texas. I live in Texas, so I speak to it. But there's Florida, there's Arizona, there's Georgia. There's so many states that are seeing a huge influx of population. So obviously there is growth in the real estate markets there. When there is growth, there's two types of growth. One is you have the cash flow, and the other is the equity growth, which is the appreciation of the investment itself. So you benefit from both of those when you invest passively. The fourth one I want to talk about is superior tax advantages. So there is something called depreciation in single family homes. Unfortunately, it tends to be quite small. And we'll talk about what's the difference between a single family home depreciation and a depreciation in a commercial property, whether it's an apartment, senior living, whatever kind of commercial property. We'll talk a little bit about the depreciation difference between those two. And it's not even commercial as much as cost segregation is a topic I'll talk about. And that applies when you have an expensive home, maybe over $1 million, you can look into doing a cost segregation. For those of you in California, you could do it on a single family home as well and benefit from a good amount of depreciation, especially if you plan to hold the property for a long time. We'll also talk about portfolio diversification, because syndications allow you to not only invest with your cash accounts, but also use your retirement accounts. And we'll talk about that. So what is a syndication? Google defines syndicate as a temporary alliance formed by professionals to handle a large transaction that would be impossible to execute individually. Really what it is that people come together, pool their resources, and then share both the rewards and the potentials, the risks and the potentials for the reward on that investment. This is ideal for people who are busy, like let's say professionals who have full-time jobs and who really don't have the time to spend a lot of time doing a syndication. Perhaps you do have the time, then maybe you should look at how do you become a general partner in a syndication. So that's something I'm open to talking to people about. So if you're really interested in becoming the actual management entity of the syndication, then that's also an option. I'll speak to this from a general syndication perspective, not necessarily a GP or LP side, but from a limited partner or what we call the person investing the money into the syndication. This is sort of like the high level 10,000 foot view of it. So let's talk about the parties in a syndication. We have the general partner. So general partner would be someone like me. We perform the underwriting for the syndication. What does that mean? It's just a fancy way of saying the financial analysis for the syndication, for the apartment or the investment we're buying. We need to make sure that the numbers work, right? So that's the underwriting. We have identification and acquisition. So by the time we buy one apartment, we probably have put 20 offers or 30 offers on apartments, right? So it's not very easy to find good properties which make sense in this hot environment. So we do a lot of research and figure out what are the good locations to invest into that we can get better rent bumps, for example, more rent for the money, for the dollar that we're putting into the property. So we also talk to brokers. We have lenders, we have investor relations. So obviously I'm talking to you guys as an investor relations person. We also have attorneys involved in the syndication. We form legal structures and we have a lot of paperwork which goes into it. This is a highly regulated industry, so we can't just willy-nilly put a syndication together. There are a lot of SEC rules around syndications that we have to follow. So it's all very legal and structured well to protect investors getting into a syndication. That said, it doesn't mean you don't do your due diligence. You should always do your due diligence on the sponsor, on the deal, and everything else you're getting into. But there is also some legal recourse that you have when you get into a syndication. We also work with in-house property management or third-party property management to perform ongoing what we call asset managers. So when I buy a 300-unit apartment, I'm not a property manager, right? I don't run the property, but we hire a third-party property manager. We manage the managers. So we make sure that our business plan is executed. We do the improvements that we plan to. We pull back on those improvements when it doesn't make sense to, like COVID. We stopped renovation on all these properties because it didn't make sense. We couldn't push up rents during COVID, right? So those are the kind of decisions which an asset manager makes. We also provide you monthly reporting and cash distributions, whether it's monthly or quarterly, on these properties. So the cash distributions come from the cash flow of the property. So it is passed on to the investor after all the expenses. We also track the execution of the business plan. So whenever we put a syndication together, the sponsor will always have a business plan for the property. Whether it's a new build, the new build business plan is, I'm going to build this apartment, I'm going to stabilize it, which means put tenants into it, and we're going to sell it to an institutional investor. Whatever that plan might look like, you always want to walk in with a professional plan that your sponsor is putting together whenever you do a syndication. We also manage the disposition of the asset as well as the disbursement of the investor funds and capital, the initial capital that you put in plus all the gains from the project. So who's a limited partner? So I assume most of you are here to learn about syndication. So you would be the limited partner in a syndication. Limited just means that you have limited capacity. You're working in a limited capacity in that partnership where you put in the money. You can, of course, you can ask us questions and you have some rights in that partnership and the legal documents will outline all your rights, but you're not day-to-day operating the capital, operating the property. And most of our investors don't want to operate the property because they just want to put the money and have their money work for them. They don't want to be working. So that's what I mean by really passive. So you get a K1 at the end of each year. By April 15th, we send out K1s. What is a K1? It's basically a partnership legal document. It's like a 1099, but for for a property because it's a partnership. And we tell you, here is what's the income you had, here is the depreciation we are passing on to you as partners. You also receive the cash on cash distributions and property reports, and you benefit from both the cash flow and the appreciation in the property. Sometimes we structure them as a debt investor, but they're still in the equity pool. So the way it works is it's a little bit like, think about it as I get a flat fee, like a 10-12% return, let's say a 10% return, but it's paid out over 5 years, and you don't participate in the equity of the property, but you get paid first before everybody else. So in a sense, your returns are more, I wouldn't say guaranteed. Guaranteed is the wrong term to use, but your returns, you are the highest, the first paid on the stack. So you're likely to get paid, right? So you have the first preference on these returns, but you're still a equity investor. You're not a debt investor. So let's talk a little bit about typical. I see a lot of questions, and I'm going to get through all the questions, I promise, but I want to keep the flow going. So I'll keep the questions to the end. Typical return structures in syndication. Typically, you'll see two different models. Now, the model will depend on the sponsor that you're working with. It can change from sponsor to sponsor. There are some groups which will only do what we call a straight split model. There are some groups which will only do preferred return model. There are some groups which will switch between the two depending on the deal. Now, what do you mean by preferred return model? So the preferred return model works on the fact that, let's say I tell you, you get an 8% preferred return from the cash flow. What I'm saying is, if the property cash flows 8%, you get 100% of that 8%. That's what a preferred return is. If the property cash flows 9%, you still get your 8%, but that remaining 1% is split in a certain way, which brings me to the second one, which is the GP-LP splits. So if we make enough cash flow that it exceeds the preferred return which is promised to you, then you split that extra with the investor, with the GP or the general partner in a certain ratio. Now, it could be 70-30, it could be 60-40, it could be 50-50, depending on what you're investing into, the asset class. So it could be multifamily, generally 70-30, but if you go to a new build, it's a 50-50. Why is it 50-50 in a new build? You can think about the amount of work the sponsor has to put in a new build is much more than the amount of work that will take to do maybe a light value add. It could even be 90-10 in some cases, if the sponsor is not putting in a whole lot of work in the property, or if the sponsor really wants to make the deal work, and they're willing to take less fees, then it could be a 90-10. So the equity split also, the GP split is not only for the cash flow, but also for the equity on the property. So let's say we have back-end equity, right? Like we sell the property and we realize, let's say we bought a $10 million property, we made $4 million on it. Now, on the back end, when we sell the property, we have some cash there from the sale. So that split is also based on this 70-30 or whatever LP-GP splits are there. So if you look at it in a lot of markets right now, cash flow is really tight. For those of you who are looked at Austin market, you know that there isn't a whole lot of cash flow on these properties, right? But really what we're working for is the back end, right? The appreciation is the name of the game in some of these growth markets. But let's say you go to Midwest, you go to maybe Tennessee or Alabama, maybe not Nashville, but some other cities. There is a lot of cash flow on the table. So there could be a preferred return plus a GP-LP split on top of that. Another thing you'll see is what's called a hurdle. A hurdle is very simple. I say that if you reach a specific IRR, an IRR is an internal rate of return. You can think about it as a time value for money. And if you just Google it and see what our IRR calculation is, it's a pretty complex calculation, but all it's really telling you is if you invest, let's say, same dollar for a longer period of time, and you make the same amount of returns, your IRR is lower because now the time value of your money is spread out over a longer time. So people do what's called a hurdle. They'll say, okay, I'll do a 70-30 split with you, the sponsor. But if I achieve a certain level of return, let's say 13 IRR, then my splits change from 70-30 to 50-50. This is not necessarily a bad thing because it's incentivizing the sponsor to give you better returns because they don't get that 50-50 split until they achieve that hurdle. So it can be a very good structure for you to work in the preferred return model. The other model, I prefer that less, but a lot of sponsors do it. It's a straight split model. So let's say they say it's an 80-20 split. Now, if the problem with this model I find is that even if the sponsor's making a 5% cash flow and they promised you 8, but they didn't make the 8, they still get to participate in that 5% split 80-20 or whatever the agreed upon ratio might be. So to me, that is less investor favorable and friendly. So I like my investors to get paid first. So I prefer the preferred return model. So a lot of the models might be straight splits on the back end as well. So everything on the back end, let's say I have some equity on the back end, then it's split the same equation, the same splits 80-20. This could also be structured with or without hurdles, the straight split model, but generally they don't do hurdles on these kinds of straight split models. The most common one you're going to find in the industry is the preferred return model. And to me, that's more favorable from an investor perspective. So I want to really talk about a little bit about, a lot of people ask me, should I set up an LLC to invest into a syndication? And here is my answer. If you ask a lawyer, the legal answer is, the good answer is yes, you should. You should always protect yourself and whatever investment you're making. But most of the time, there's a plethora of LLCs when we do these investments. So you're really sitting behind a lot of LLCs already. So if it's your call, if you want to set up another LLC and do the filing for the LLC and all the paperwork for it, we don't necessarily require it. You can invest as an investor, as a direct individual. You can invest as a family trust. You can invest as an LLC. You can invest as a retirement account, like an IRA. So there's a lot of ways to invest into a syndication. But again, setting up an LLC is up to you. There's no specific requirement we have. So let's talk a little bit about the pref model, right? I just mentioned how we structure the GP and the LP splits. So for example, in this example, we have limited partners. They are earning an 8 pref, okay? We might have a fund outside of the base fund. We might have 2 layers of LLCs. Why? Because maybe someone else is running the investor fund and someone else, a couple of other people are running the base fund. This happens a lot in syndications. Now, 70% split for the LP, 30% split for the general partner. And they're generally 2 different classes of investors in the LLCs, but we usually call class A, B. Sometimes we've had class A, B, C, D, and we gave class A 10%, 9%, class B 8%, depending on the amount of money they invested. So let's say you invested $500,000, you got a class A a tier, which guaranteed you, not guaranteed, but allowed you a 9 pref. And one more thing I want to mention, in a lot of these syndications, you want to watch out for this word, catch up on pref. What that means is, let's say the first year, if I buy something in Austin at 4 cap, there isn't an 8 pref to pay out. Like I can't buy a 4 cap property and make 8% return, right? So the sponsor might tell you the first year return might be a little bit low, but we'll play catch up. So that means that they still owe you 8%, but they might pay catch up in the future years. And catch up is a good thing. You want to see that investments you're doing have a pref catch up. That's one of the questions you should probably ask your sponsor too. Then you have general partners. They might go to an investor fund or they might go directly into the manager LLC. And the base fund now invests into the property. That's usually the structure. In some cases, we might be missing this investor fund and we might just have the base fund and the property and the manager LLC. The manager LLC are all the general partners who are in the partnership. The limited partners are people who are investing into the syndication. One more question that I get a lot from investors is, does the manager invest into the investment? Absolutely, yes. If your managers, if your sponsors, or what we call general partners or sponsors, I use the word interchangeably, if they're not investing their own money into the syndication, that should really make you pause, because you want skin in the game, right? You want their skin in the game. So definitely look for that when you invest. Ask them how much they're investing. Sometimes, let's say we have 5, 6 sponsors, but only 4 of them might be investing, which is fine because they have a finite source of money. They might be running out of money from deal to deal to deal, right? So as long as the sponsors have a good amount of capital in the deal, I think it's fine. Not every sponsor in the deal has to invest. So let's look at a quick high-level overview of how we acquire these properties, right? We evaluate the investment. There's a lot of work which goes in behind before we even acquire the property. So we evaluate the deal location, we look at the market data, we look at absorption, right? How many units are being rented? How many units are available in that market? Perform financial projections. We'll do what's called a pro forma analysis, which is a 5-year analysis of the property. And we look at what are the growth opportunities in terms of net operating income. And I'll talk a little bit about that. I tend to talk a lot, so I'm just keeping an eye on the time. We submit the LOIs, which is called the letter of intent. We don't have a direct contract in most of these commercial properties because the contract tends to be very complicated. It's not like a standard 1-4 residential housing contract. So we do what's called an LOI process, which is a letter of intent. We make offers using a 1-page LOI, which we outline the broader aspects of our offer. And then when we, before we submit the LOI, we even get an idea of what the financing looks like get the term sheet from the lenders. And then once it's under contract and the LOI is accepted, then we execute what's called a purchase and sale agreement, or PSA. You will hear that a lot, to put the property under contract. We usually pay an earnest money deposit, and a lot of times the sponsors are putting a lot of money into the property even before your money comes in, right? We bought a property recently in Katy. We put almost $500,000 into the property just to execute. That was our EMD, which is earnest money deposit. So a lot of money goes into these larger properties. So you should be aware of that. So let's talk a little bit about what happens after acquisition. We perform, not after acquisition as much as pre-acquisition still, but we do perform PSA due diligence on the property after putting it up, signing the PSA. We sometimes do something called an early access, where we perform the due diligence even before PSA. So we'll get an early look at the property to see if that's what we want to buy. A lot of these times, a lot of these places, we put a lot of money that we might never get back. It's called hard money. So we do lose money on these offers sometimes because we have to be very competitive. Then we initiate what's called a private placement offering. This is the SEC legal requirement for a syndication. So we open up the offering to investors and we say, okay, the minimum investment is $50,000, $75,000, $100,000, whatever the case might be for that investment. We raise the capital. You'll be signing some documents and wiring your funds for the investment. And then we'll go in and actually purchase the property at that point. Once we have all the investor funds, we go in and purchase the property using the investor funds and our own funds as a down payment. And we also keep enough reserves for renovations and everything we plan to do to the property. So what happens with the operations? We execute a business plan. Any property you get into should have a business plan, even if it's a new build, or it is a existing property. We update the investors and keep them on track with our financials as well as the progress of the property. We make distributions, which is usually monthly or quarterly. And then we share the equity. We might sell the property after 3 to 5 years or whenever we feel it's appropriate. And then when the investor goals are achieved, we want to sell the property and distribute all the equity returns. So a lot of people ask me, what are the returns in a syndication? Like I mentioned, cash flow, we have equity. It allows you to diversify, and there are risks, right? If any property like cash flow can be impacted, like COVID impacted a lot of tenants, especially in the Class C properties, which are the lower income, affordable workforce housing properties, right? So they weren't able to pay and it impacts our bottom line. So you have to be careful about that when you get into a deal and ask the right questions. So the total returns are a combination of cash on cash and equity returns. Now, I don't want to give a number, but typically we've been doing about 75 to 85% over 5 years. Is that true for every deal? No, it just depends on the deal, on the market. With new builds, it is completely different. With an existing property, that might be what it looks like. So let's talk a little bit about some important terms in real estate investing. We'll start with cap rate, and I have a feeling I'm going to run over. So hang in here with me. I'm going to try to get through all of this. And I promise this will be really useful for you when you're evaluating a deal. So what is a cap rate? A cap rate is a very popular measure for assessing the real estate potential, the investment potential in terms of profitability and returns, right? So it is represents the yield of a property over a 1-year horizon, assuming that the property is purchased all cash. So we don't factor debt or leverage into cap rate calculations. The reason is simple, right? Everybody can place a different debt, different terms, and the numbers will all be skewed. So we want a constant metric to calculate to figure out, okay, what is the potential for a property? So if I put $100 into a property, what is it going to return me before paying my debt? That's all basically I'm trying to figure out. What's my cap rate is by basically what I'm getting for every $100 I put into the property. So it's defined as net operating income divided by value of the property times 100. So basically, let's say I make $100,000 before debt, right? Before any debt payments. And this is new to single family investors. They always calculate debt payments, but not in commercial. So you have 100,000 divided by the value, which let's say you pay $1 million, and that's a 10 cap property. So are we getting 10 cap properties in Austin? Not even close, right? We are somewhere in 3.5 to 5 cap, depending on the location, the age of the property, and so on. So cap rate is also kind of proportional to the risk of investing into a property and the demand in the property of the market. So for example, Austin is a high demand, hence low risk market. And so the cap rates are really low. So it's kind of opposite to what you would think. So cap rates are low means there's less yield on the property for every $100 you put in. So if I tell you 4% is my cap in Austin, you're making $4 for every $100 you put into the property. That's all it means, right? And assuming no debt, right? If you ever put $100, of course you're placing debt, right? We are placing debt, we are getting leverage. So that increases our yields a little bit because right now we are getting under 3% debt for our properties. So we are able to leverage that to get a little bit more cash flow, right? So lower supply, higher demand, lower cap. That's really what it is. So what's post appreciation? So market appreciation is when your market goes up. That means what does market going up for a commercial property mean? The cap rates come down, right? The market's willing to pay that much more for a property. So that means the cap rates are actually inversely proportional. But forced appreciation is a different concept where we can force an increase in the value of the property. And the way we do it is very simple. So we can't control. So if you go back here, we cannot control the cap rate of the market. The market is what it is. We control the value is equal to NOI divided by cap rate. So we can control the NOI and make the NOI go up, which means the property yields more dollar for every dollar, right? So you increase the value by increasing the money that the property generates or the net operating income. You also increase the NOI by decreasing your expenses. So you can do one or both, right? And usually our game plan is to do both. We increase the amount of money that the property generates. We also decrease the expenses that the property has. So let's look at a forced appreciation example. I bought a 20 unit property for $1 million. Not happening in Texas, most Texas markets, unless you go to probably a secondary market. My rent is $1,000 per month per door. Per door is per unit, and that's $20K a month, which is $240K a year. Now my expenses, I'm just putting everything together: property taxes, insurance, repairs and maintenance, property management, anything else, marketing. I might be paying anybody else, all included. Let's say it's 140. Your net operating income is income minus expenses, which is 100K. So if you bought the property at $1 million, then you just had it, you got a purchase cap of 10 cap. I hope that's clear. Let's say, hypothetically, I sell it in 2 years. But in those 2 years, I've increased rental income by $50, $25 each year. That's it, right? So per door, again, that's $50 over 2 years. So that's essentially 50 times 20 units times 12. So I have $12,000 per year. This is month per month, and this is per year. So essentially what we've done is we've increased the property income from 240 to 240 plus 12, which is 252. Now we reduce expenses by the same token by, let's say, 8K. I decide, hey, I'm paying for water. Tenant should be paying for water. You'll find that a lot in San Antonio properties. Landlords are still paying for the tenant's water. So let's say I was able to cut back those expenses and I found a property where I was paying for water as a landlord. I bill it back to the tenants and I collect an additional 8K. Now my new net operating income is 240 plus 12 minus 140 minus 8. I just dropped my expenses by 8, right? So essentially my net operating income is now 120. Now, what is my new value? Applying the same cap, let's say the cap rate hasn't changed in 2 years. I have NOI divided by cap rate, which is 120K is my new NOI, and my cap is the same. So now my property is worth $1.2 million. So in 2 short years, just by increasing rents by $25 and decreasing expenses by just 8K a year, we achieved a $200,000 increase in the property value. Now, think about it as in scale this up, right? Make that $1 million property $10 million. You could achieve a $2 million increase in the property value, assuming that the market did not appreciate, because the appreciation is only coming from the property, not the market. Now, if the market appreciates and the cap rates go down, instead of, let's say, 10 cap, the market is at a 9 cap, then you're going to make more money on the exit. I hope that's clear, and I'll answer more questions, come back to this. So let's talk a little bit about depreciation. So depreciation of residential assets is based on, it's very simple. You take the value of the property. Let's say you paid 300K. Now you take the value of the land. Let's say the land was 50K. I remove that 50K from that 300K. In this example, I'm taking 200. Land value is 75. Your depreciation is calculated on the structure, because land cannot depreciate. Land doesn't get old, right? Like you cannot lose money on land. So it's 200 minus 75, divide by 27.5, and that's what IRS wants you to do for single family homes. So you get a depreciation of 45. So what does depreciation mean to you? It basically means it's a negative income, or a loss, if you will, a paper loss for you to take off against the income from the property. So if the property is, let's say, generating $5,000 of income a year, your single family home that you're renting, you get to take off 45 from that $5,000. Thereby you're paying only for $400 something in income. But That's not a lot, right? A depreciation of this 4,500 is not a lot. But think about commercial assets, right? They are depreciated over 39 years, which seems like they won't depreciate a whole lot, especially if there are so many investors in the deal. But we have something called bonus depreciation, where it allows the business to immediately deduct in the first year of ownership a huge percentage of the purchase price rather than 39 years. So this is available for us to use. And this is combined with what we call cost segregation to get a huge amount of first year depreciation. So let's talk a little bit about cost segregation. What is cost segregation? It's a strategic planning tool that allows you to increase the cash flow by accelerating depreciation deductions. How do we do that? Let's take a building. Now, you can take the building in its entirety and depreciate it over 39 years, or you can break the building down into subsystems. So you have furnishings, you have fixtures, you have plumbing, you have flooring, you have electric. All of those depreciate on a different schedule. So the IRS says, okay, the roof is, let's say life is 15 years or 20 years, whatever that might be, or 10 years, then it's depreciated over 10. The plumbing has a 20-year lifespan, let's say 15-year lifespan, then it's depreciated over 15 years. So all of these they're itemized, so to speak, and then you take the depreciation for all of them separately. That allows you to fast track the depreciation over a shorter period of time. Now, as if that wasn't enough, what they said was anything which can be under 15-year depreciation can now be taken in year one. So what does that mean to you? Every $100,000 that you put into a property, you get a negative income or a loss of paper loss of over, let's say, anywhere from 40 to even $90,000 in some properties. So essentially what happens is if there's cash flow in the property and you're getting returns, all of those returns become tax-free for the whole period of the property or tax deferred because of depreciation. All right, so this is the last section. I'm way over time, so I will still leave time for questions, and thanks for hanging in here. We'll just talk quickly about the types of syndication, investors, and investments. So you are going to see a lot of different types of syndications. Earlier, I used to generally talk about value-add syndications, where you're essentially upgrading units, increasing rents, reduced expenses, and that's what I spoke about when I talked about forced depreciation. That's called a value-add play. Then you'll see what's called a yield play. When we buy a property, we don't think it needs a lot of value add. It's fairly new. It looks pretty good. We're just going to increase rents a little bit because they're under market, but mostly just keep the property the way it is. We're not renovating the property very much. Then it's generally called an yield play. You're just buying the property as is and then buying it for its cash flow. It's not possible in all markets to do yield play because the cash flow has to be pretty good. Then there's hybrid, where you might do a little bit of value add, but not too much, but there's already cash flow on that, right? Then you have the new builds. It's becoming very popular as prices start increasing, that the delta between older apartments and newer builds are narrowing every single day. So new builds start to make more sense. You have build to rent, you have build to sell. Build to rent is, I'm going to build, I'm going to have renters coming in and living there, and I'm going to possibly hold on and benefit from the cash flow of the property. The build to sell model is, I'm going to build, I'm going to tenant it, and I'm going to sell it to someone and exit the deal. Low maintenance, it's a new property, there's hardly any maintenance, and no cash flow during construction. Obviously, the first couple of years of the build, there's no money coming into the new build, right? So you have to kind of be prepared for that when you get into a new build, but the returns can be much better than existing properties. So let's talk a little bit about what an accredited investor is, what a sophisticated investor is, because people need to understand this when they get into a syndication. Like I mentioned, the SEC regulates a lot of this. The SEC says an accredited investor is someone who has earned an income that exceeded $200,000 or $300,000 with a spouse in each of the prior 2 years, the last 2 years, and expects the same, or has a net worth, or has a net worth of over $1 million, but that million cannot include the primary residence. So for those of you in California with a huge expensive primary residence, you cannot include it in your net worth calculation. But a lot of people in California qualify as an accredited investor because of their incomes. Their incomes are substantially higher. So you needn't be an individual. You can be a LLC, your bank, you can be a partnership, you can be a nonprofit. So there are a lot of ways to become an accredited investor. SCC has actually expanded this definition and said there are certain types of financial professionals. I believe it's a Series 65 license. People who hold certain financial licenses are now also accredited, even if they don't meet these criteria. Who is a sophisticated investor? The SEC says a sophisticated investor is someone who understands the knowledge, has the knowledge and experience to evaluate the risks and merits. So for example, you're here learning. So you want to be able to figure out, okay, am I educated enough to make this investment, right? And you don't want to just rush in and do something everybody's doing. You want to be an educated investor. When you're an educated investor, whether you have a net worth or not, you become what's called a sophisticated investor. So no income requirements, but in each of these syndications, we have a limit on how many investors we can take in who are sophisticated. And there are certain types of these syndications where we cannot take any sophisticated investors. And I'll talk a little bit about that. So you want to be educated in investments, whether it's a stock market or similar investments. You want to understand that every investment comes with a certain amount of risks, and you're willing to take on that risk in return for the higher returns. What are securities and how do they come into play in syndications? Securities are tradable financial instruments that are used to raise capital in public and private markets. So what we are doing here is essentially raising what's called private equity. We are raising capital in a private market, which is all you guys, investors out there, who want access to invest into larger buildings and do less work. So there are three types of securities. There's equity, there's debt, and there's hybrid. And equity is there. Most of our investors, the investments that we do are structured as equity investments, where you are coming in and you're sharing in both the upside of the property as well as the cash flow of the property. But within that equity stack, as we call it, we might have a higher return for some folks that don't share the upside, right? We'll give them preferred equity. It's called preferred equity. So we all have to follow the federal security laws because we either have to register with the SEC or we have to meet an exemption. And most of these are exemptions. So because our offerings are structured in a way which follows what's called a Regulation D or what's called Reg D very often, it gives us access to capital, like small companies that otherwise cannot go through a normal SEC registration. So SEC registration can be very expensive. So we have to file what's called a Form D with SEC, and it still goes through a lot of SEC scrutiny. So what's a typical document in a syndication? The first one you have to know about is called a private placement memorandum, or it's called PPM. It discloses everything about the deal. So it says who gets paid what can go wrong. If something goes wrong, who gets to say what? Let's say something happens to a sponsor. What happens if the sponsor dies, the main sponsor? So who are the other parties? What is the role of you as an investor? A lot of people will not read a PPM, but maybe you don't like to read legal documents, but you should want it verified maybe with an attorney, unless you're comfortable reading. So it disclaims, a lot of people are also scared when they read the PPM because it talks about all the ways the deal could go wrong. The reason we do that is we want to talk about all the risks so people are aware of the risks when they come into the property, right? It's not all hunky-dory always in any investment. So sometimes it can be scary to read a PPM, but that's what you need to learn and understand. We have the operating agreement, which is the rules and procedures of how we invest, how we operate that LLC, which is our property. We have it's a key document for dispute resolution, like who has what rights in the property, what does a GP do, what is their role, how much do they get paid, all of that stuff. Then we have the subscription agreements where you say, okay, I'm going to buy put in $100,000. Maybe usually it's units. Every unit is maybe $1,000. So you're buying 100 units into the property for $100,000. So that's what's called the subscription agreement. Then we have the investor questionnaire. It'll ask you, who are you? What's your name? What's your address? Are you a sophisticated investor? Are you an accredited investor? If you are sophisticated, you have to know the sponsor, and they're basically protecting you, right? You want to understand who the sponsor is. Then we have a business plan, right? We talk about what the credentials are, the financials, the returns, hold period, market specifics, a lot of things. So I've been going for a long bit of time here. I think people are dropping off, but hopefully you can catch up. I'll talk a little bit about the B's and the D's, the B and the C syndication, types of syndications. So the B syndication is 506B, it's called. We can have both accredited and sophisticated, with up to 35 sophisticated. This is open only to accredited investors, which means we have to actually use third-party verification to see that you're accredited, okay? What is the difference between, in terms of investor relations? You need to have a substantive relationship with the sponsor. You should know the sponsor. The sponsor should understand your financial situation. The reason is simple. We want to protect you. If you have $100,000 and that's all the money you have, and you're broke if you lose that money, it's not a place to put in a syndication, right? We don't want that. So that's why you want to have a substantive relationship with the sponsor. The downside of it is we can't promote it on social media. You're never going to see a B deal on a social media or any other public platform. Whereas a C deal can be freely promoted everywhere, does not require you to know me or any other sponsor to invest into the deal. The accreditation verification is called self-accreditation. Even if you're accredited or not, we can still bring you in, but we'll still ask you if you're accredited. And if you say you are, we take your word for it in a B syndication. In a C, we have to do a third-party verification with a CPA attorney or a platform we call Verify Investor. So this is the last slide. I know there's a lot of content here. Hopefully this was useful. Let's talk a little bit about how you can invest into syndication. You can do a cash investment. We issue a K1 every year. There are tax implications on the distribution, but we have a lot of depreciation on that investment to offset all the dollars that are coming in as distributions on property. Usually on the sale, there'll be some amount of depreciation recapture, so you will have to understand the logistics of that. We also have self-directed IRA investments where you can roll over your old 401ks or a regular IRA, like a Vanguard IRA or any other IRA you have, into what's called a self-directed IRA, and you can use that for investing. But there's something called UBIT, which is unrelated business income tax, which comes into play on the sale of the property. So you should be aware of that. We generally, I tell people if they can do a solo, they should go a solo 401k route instead of STIRA. But I'm happy to discuss that offline. I also have a video and some blog posts talking about the difference between these two on cherrystreetinvestments.com. Last one is solo 401k. It's available for self-employed business owners. Really, this sounds like if you're a W-2 employee, you can do this, but that's not true. Let's say you have an Amazon store or you have an Etsy store. The self-employment can be any small business. It doesn't have to generate money. It doesn't have to be a lot, right? So it should have no employees though. That's important, except your spouse. I believe that's allowed. Any active income business and no UBIT to deal with, and a lot of the pre-tax contributions into solo 401ks, and it's taxed at withdrawal. So with that, I think I've come to the end of my discussion. That was like a fire hose. So let me go through some open questions here. We have a lot of open questions. I hope that was useful. How can investors reduce risk while investing in syndications? Do your due diligence, figure out, look at the numbers, look at the sponsor. I'd say sponsor is the biggest, most important part of the equation. Invest with someone you trust, because if the sponsor is doing enough work for you, and you trust them, that's a good start. But also look at the location, look at the submarket, where the property is. Go to Google Maps, do a search, right? Figure out, okay, does that, go to apartments.com and look at the rents around the property. Does that sponsors rent projections make sense? So there's a lot of due diligence that's very easy to do from an investor perspective. And that alone, I have a webinar talking about due diligence for apartment investments, for example. So it's online on YouTube, and I'm also happy to do it again sometime. What is the minimum return on investment that's considered a good passive investment? All depends on the risk for the investment, Keng. Unfortunately, there isn't a single truth, right? So let's say you're investing in multifamily right now with value add, what we call value add multifamily, you're looking at maybe a 14 IRR, maybe a 15 IRR in some markets, maybe even a 13 IRR. If you're going to mobile home parks, maybe you're making 18 IRR, right? It all depends on what is the investment, what market it is, a lot of different factors, like what kind of investment it is. So let's see, Anna says, do you have a recommendation of a percentage allocation of the 4 tiers? Anna, I'd say the percentage allocation depends on your age. As you get older, you want to kind of come down the pyramid and kind of invest in more safer and safer assets. You want to reduce your risk as much as possible. So that percentage allocation will keep changing for the different tiers. How much you want to put into each, again, depends on what your growth is, right? Like, for example, the stock market, it can get great returns, but it also comes with a great amount of risk. So how much are you comfortable losing when you invest? How do you transition from a GP to an LP? What's your recommendation? Okay, Anand, that might be an offline question. A lot of work to go from an LP to a GP. You need to educate yourself, and that might be a great place to start. We are actually putting a program together for some folks who are very interested in becoming GPs on how to transition, and that will be an 8-week program we're putting together. So Anand, stay tuned, or reach out to me and just shoot me an email. And I will share my contact information here while I'm answering questions. Shoot me an email and I'm happy to talk about it. For a limited partner, if the investor wants to get involved in operations from a learning perspective, is that an option? Snehal, unfortunately not in most cases, because yes, we're happy to talk to you, but daily operations, it's not a possibility, because we would basically have too many cooks in the kitchen. Just isn't an option. I would say if you really want to get involved in learning, then it's a good idea to look at some of the multifamily mentors who are out there. Like I said, we are putting a program together. There are a lot of asset managers who have programs that I'm happy to recommend as well. Can a K1 be paid to an LLC? Should I get an LLC started right now? Absolutely, a K1 can be paid to an LLC. K1 is not a payment really as much as it's a tax statement. I'm not a CPA, but K1 is basically telling you what you got paid and what your LLC got paid. If your LLC is a single member LLC, which is a pass-through entity, meaning it flows into your social, it really doesn't matter. Ultimately, the money or the cash flow or the income or the negative income will pass through to you. Who invests in the base fund? Anand, both. We might have two sets of sponsors. They want to handle their own investors. So we might have a base fund. We might have a fund on top of the fund, because some properties I get into, I'm setting up my own fund and I'm bringing a chunk of money into the base fund. The base fund is actually investing into the property. So it's a way for us to raise money in a pool and then take the pool and put it into the property. So that's all it is. Anand says, where do you find out how much the GP have invested? You ask the GPs and hopefully they're honest with you. There is no way to find out. You want to ask the GPs. One of the questions you want to ask the GPs is, what are you investing into the property? What dollar amount? Or what percentage of the raise? General partners prefer partners' profit sharing and cash flow ratio to their investment just as LP or preferred sharing model? Oh, so general partners can also be limited partners, Snehal. So let's say I am investing as a limited partner, then I'll get whatever the limited partners get, just like you would get. But the amount that I'm investing as a GP is generally like not, I don't invest anything as a GP. All the investment I'm putting into the property, meaning my dollars are going as an LP. What I get paid as a GP is only the splits that I have as a GP. I hope that makes sense. After we put the earnest money, just like residential, do we have an option period to get out of the deal without losing much? Great question. A lot of times in this market, to be honest, we have something called hard money. When the money goes hard, we say day one, the money goes hard. We lose a lot of the money, whatever we say is going hard, if we don't close the deal. So it's very different, a little bit different from single family homes where there's no concept of the money going hard day one. Here, to make the deals competitive, to make the offer competitive, we have to lose money sometimes. And we'll say, okay, $100,000, I put in 500,000 in EMD. Day one, I'm putting 100,000 hard, right? Which means I don't get the money if I walk away from the deal as a sponsor, but you don't lose any money because you haven't invested as an investor yet. In purchase cap calculation, do you include debt interest and all the expenses? No, we don't include debt ever in purchase cap calculation. Expenses, yes, absolutely 100% included. Cap rate does not assume that you're paying interest. You will still pay interest beyond the cap rate. So let's say you're making a 5 cap property. All that's telling you is if you didn't pay debt, what will be your returns? Now you add debt on top of it. Now remember, when you place debt, you're not raising 100% of the capital. You might be raising only 25% or 30% of the capital. The remaining is coming from the debt portion. So effectively, I've increased the yield on the property because the debt rate is so low right now. We're paying under 3%. So that's an important factor to keep in mind. Are there any other questions here? Can multiple people pool to reach a minimum investment to get in? Good question. Great question. Yes, you can. You should form an LLC and then you can invest as one LLC. So let's take an example. You want to invest $100,000. You have 5 friends. Put $20,000 together, 5 people, form an LLC and invest. It allows you to put lesser minimums and make your own, own smaller minimums. Absolutely, great question. As a limited investor, if the population increases, single family rental increases, will cap rate go down? Generally, that's what we see, Anand, whenever a market, think about it this way, if there are more buyers than sellers in the market, the cap rate goes down, right? People are willing to pay more for the same property, which means the cap rates are lower. That's it. As a limited investor, do I still have to pay taxes on the preferred return? Great question, King. Usually not, because there's a lot of depreciation. So let's say you put in $100,000, you made $8,000 the first year, but you got $16,000 negative losses for your depreciation. I told you the depreciation is very high on these properties, right? We pass to the investors is usually between 40 to 80% of their investment. So now you have negative 60, let's say, and plus 8, you come up with a negative 52. This is just simplifying it, but you don't pay taxes because there's so much depreciation. I hope that makes sense. Snehal says tax savings. Since individual investors get K1, which is taxed for the individual income, so how does this tax saving work or enable? So the tax saving is on whatever returns you get. That the depreciation doesn't flow into your W-2 income, Snehal. So that's different. Whatever income that property is making, your tax depreciation will offset that income. It won't offset your W-2 unless you're what is called a real estate professional for tax purposes. If you want to learn what that is, it's a gold mine. You can take depreciation and applied towards all kind of income, even capital gains from the stock market. So all your goal here should be to become a real estate professional for tax purposes, not to give the big secret away, but that's how you don't pay taxes and reduce your taxes. Is Reg D an exemption? Yes, it's an exemption, Anand. Rishi says, I don't see many build-to-rent syndications. It seems a good way to build a portfolio of cash flowing properties. Rishi, that's what I'm working on right now, looking at build-to-rent syndications because I'm getting tired of value add. I'm starting to look at build-to-rent. Katrina, the slides won't be available to you, but I will be sharing a recording of this. Please go subscribe to my YouTube channel and you'll see the recording on YouTube. My YouTube channel is Cherry Street Investor Education. If you're investing from a partnership, LLC does each of the partners to be accredited. For a 506C offering, that's correct. If the LLC let's say I say it's a 506 offering, you can only invest an accredited investor. The entire LLC has to be accredited. There are two ways for an LLC to be accredited. All the partners in the LLC are accredited, or the partnership has more than a $5 million net worth for the LLC itself, or in assets, investments, then the LLC is accredited. How do you find the track record of the sponsors? You ask them for their track record, and there's no way to find it. You can go do your own investigation. You are welcome to run background checks on the sponsor. Most sponsors should be comfortable with that. I am comfortable with that if anybody wants to run a background check on me. But you want to make sure that you understand what they've done, what they've not done, if they have any bankruptcies, if they have any walked away from deals before that they haven't performed on. You want to ask the sponsor, how many deals did you have go wrong? I mean, deals will go wrong when you do enough deals, right? That's not the problem. How you communicate to your investors, how you recover from those mistakes are more important than having a mistake ever, right? I'm not looking for a perfect past, but I'm looking for someone who's learned from their past and who's doing well now. What is a GP and LP? I might have missed while explaining. I'm going to send you the recording. It's too late to go over it right now. What is the minimum investment amount I've seen? The lowest I've seen is 25K, which is a very small property. So think about it. If the raise is only 2 million, I can do a 25K investment. If I'm raising $13 million, I'm not going to do a 25K minimum. That means too many investors to deal with. It's too much headache. So the investment amount, the minimums usually go up as the raise goes up or we buy larger properties. What's the average fees that the sponsor charges and how does this affect your projected returns? There is no sponsored fee as much. There will be an acquisition fee. It's usually like 1 or 2% in the initial phase, like the first time the sponsor buys the deal, there'll be an acquisition fee for all the work they put in. But during the course of the investment, if there's a preferred return, for example, like 9%, and the cash flow is not more than 9%, sponsors are not getting paid. But there is something called an asset management fee that sponsors usually charge, which is 1 to 2% on most deals. So those are the usual fees. Good question. Asset management fee, acquisition fee, and usually the splits. That's it. The projected returns take into account all of those fees. They are after the fees. Snehal asked, what's your personal risk as an LP apart from losing your invested money? There is really no risk as an LP. Nobody's coming after you. The worst which can happen is losing the property. As a GP, I stand to have more risk, taking on more risk for my credit and for the property, the ownership of the property than you do as an LP. You don't stand to take on much risk. Our LP investments basically second lien on the property. Absolutely, Subi, that's exactly what it is. Think about it. If you go buy a single family home, you're actually having a second lien on the property, if you think about it that way. So your primary lien is your lender. If they lend you 75% of the investment, that's single family home that you just bought, you are the second lien holder and you paid the 25% down. It's exactly the same position LP. 75% might come from the lender and the rest will come from all the investors, including us. Tina, if a group of people form an LLC to invest 100K, how does it work to be accredited or sophisticated? I think I talked about it. All of the investors in the group have to be accredited. or the LLC has to have assets over 5 million to be accredited. Otherwise, you can still invest in 506B syndications. Is there a way for LPs to communicate after investing in a deal? Generally not. A lot of LPs don't want other LPs to be contacting them, Anand, in case something goes wrong. Maybe you want to get a mutiny together and bring down the sponsor. Yes, you can do that, absolutely. There have been deals that went wrong. Let's say I as an LP, we get together with other people and say, what can we do? How can we communicate with the sponsor? So there's no like sharing of information per se, because a lot of people don't want their information to be shared. So there's that question there. I think I got through a lot of questions. Is there a webinar on tax savings? They just have recorded a few webinars. If you go to my YouTube channel and check it out. Also have a webinar on March 4th. Is that next week? I'm losing track of time. March 4th with a tax attorney, and he's going to talk about the Biden changes and tax law changes, and this will be probably what you want to attend, Tejas. Thanks for attending here. Any other question? Okay, thank you so much, Kulit. Appreciate it. How do LPs protect themselves in case of deals go wrong? Rishi, we can take that offline. A lot of things to do. Will I be having a webinar on BTR? Absolutely, Rishi. At some point when I have a BTR, before I have a BTR deal ready, I will educate people on BTRs and the right questions to ask. Thanks, Indra. Thanks for joining in. I appreciate it. Thanks, Sunil. Thanks, Raj. Thanks, Indra. Thanks, everyone. I hope that was useful. That was a good hour and 51 minutes for those of you who stayed through the whole presentation. I appreciate it. I know that was a lot of information, but I wanted to give sort of like the 10,000 foot view on how a syndication works, so you're better prepared for syndications and you can decide if that's the right strategy for you for your investment portfolio. I appreciate your time, and I hope it was a useful, good use of your time tonight. Join me for our next webinar Thursday, the same time next week, with tax attorney Carl Zollner from Anderson Advisors. He's going to be talking about Biden tax law changes and how it affects you when you're a real estate investor. Thanks again, and have a good evening. Hi, I'm Kavitha Baratakke. I hope you found this video useful, and if you did, please don't forget to subscribe to my channel so you can get notified of any future videos I upload. I plan to cover a lot of investor education on this channel, and I hope you'll stay with me for it. If you have any feedback on future content you'd like to see me cover, please drop me a note or a comment on my video. Thank you for watching, and thank you for supporting me.